do you just assume the so-called verbiage of a terminal rate moves higher, and that flat yield curve we just described goes from 3.32, 3.34, 3.34, and that migrates up near 4%?
Well, I think long-term interest rates are going to find a footing here, probably around these levels. We did violate the 325, which was the high of the 2018 experience. What I think is happening is the Fed and the markets are tightening credit conditions even more rapidly than the projected funds rate. And I think that's what the market may be missing. You know, with equity volatility, with equity prices, with spreads across the high yield IG space, investment grade space, the Fed is crushing credit conditions. And that is, in fact, I think, part of what they're trying to do. This is full-on demand destruction. We got to slow the economy. Maybe we touch recession, but the only way out of this miscue, if you will, in terms of timing of the Fed getting the inflation story right, unfortunately, is to slow aggregate demand, and that's what they're focused on.
James, Ed Al-Husseini of Columbia Threadneedle was just on about a half an hour ago, and he was saying that he could see the Fed stopping the runoff of the balance sheet because of some of the credit conditions, because of how quickly the pace of tightening of financial conditions, particularly with respect to top-rated companies. Do you agree?
Yeah, I think that's possible, Lisa, but I don't think that QE in QT, if you will, I don't think the data is very revealing. I think it's ambiguous at best, the effects of the quantitative tightening or the runoff. And I don't think at this point, given what's happened with broad risk markets and what's happening with the inflation data, there's really any choice. The Fed's left it no good options. And unfortunately, we're going to have a couple quarters of this, and we'll see what happens thereafter.
So right now, do you buy into this if you're looking for income, considering that you're getting income the likes of which you haven't seen since 2009? Or do you step back because there's nothing that's going to stop the runaway sell-off in the very near term?
No, I do like the income markets. I like the fixed income markets. I like quality. I like treasuries here. I think spreads still have room to widen, including high yield. I think the municipal bond market, for those in the non-qualified world, those looking for tax sheltered income, probably have some of the most generous yields they've had in a number of years. And by the way, July, Lisa, is, as I know you know, will be a massive redemption, massive cash flow month. And I think we're going to reverse the big negative outflows for municipals. So the income space and fixed income is very generous, as you mentioned. We were 40 basis points on the 10-year just two and a quarter years ago. So it's a pretty extraordinary move.
And you say you like treasuries here, that there may be value now that yields are north of 3.3%. When do you think more people are going to come into that camp, James?
Well, I think it's close. And obviously the risk market's having these massive hiccups, being in a correction full stop in S&P and the NASDAQ, that you're going to get sort of this rotation and flow of funds data, I think, comes back into the bond market. Ultimately, as we've thought, the Fed now no longer being the indiscriminate buyer, in other words, every month coming in with $120 billion, yields, we're going to have to find a place where real investors, real hard dollar investors were interested. And I think that's upon us right now.